Click the bell icon to get latest videos from Ekeeda.
Hello friends, today we'll discuss about standard costing. Standard costing is one of the important concepts in cost accounting. Let us try to understand the concept of standard costing, its purpose, scope and various contents. SEMA terminology defines standard as a predetermined measurable quantity set in defined condition against which actual performance can be compared, usually for an element of work, operation or activity. Standard costing is defined as the preparation and use of standard cost and their comparison with actual cost and the analysis of variance to their causes and point of incidence. ICWA London had defined standard costing as the preparation of standard cost and applying them to measure the variance of actual cost from standard cost and analyzing the causes of variation with a view to maintain maximum efficiency in production. The definition of standard cost explains us that for any particular job, any particular work, a standard expenditure is estimated. It may be material cost, or it may be labor cost, or it may be overheads. Some predetermined standard amounts are tried to find out, which is estimated based on certain experience in industries or based on some information or data. When actual production is undertaken, these actual costs are compared with the standard cost. If there is some difference, which is called as variance, the causes of variance are to be analyzed so that we can have proper cost control and there should not be too much deviation in cost of the product, so that there will be proper control on cost and there will not be any problems like resulting into unfavorable results. Applicability and suitability of standard costing. Industries where standard costing is more suitable are process industries, where method of production and nature of output are the same. Example of such industries are chemical industries, distilleries, paper making, metal processing, etc. Industries where the methods of manufacturing are repetitive and products are more or less homogeneous. Example, agriculture and food products. Service industries where operation costing is also applicable, like transport, gas, water, electricity. Engineering and textile industries where large range of products are manufactured. Extraction industries such as coal, oil and timber. Where the work is not repetitive, example construction work, contract work, shipbuilding and erection work, it is difficult to set standards and therefore standard costing would not be suitable. The purpose of standard costing, it is an alternative system of cost accounting. It is a standard costing system. All units produced are recorded in cost ledger at their standard cost of production. It is a system of performance measurement. The difference between the standard cost and actual cost can be measured as variances. Variances can be reported regularly to the management in order to identify areas of good performance or poor performance. It is also a system of control reporting. When the differences between the actual results and expected results, the budget or standard cost, are large, this could indicate that the operational performance is not as it should be and that the causes of variance should be investigated. Stages or features or elements or aspects of standard costing. First, preparation and use of standard cost. Second, comparison of standard cost with actual cost. And third, analysis of variances so as to their causes and point of incidence, why and where they arise. Why there is need for standard costing? What are the limitations of historical cost? Data received is too late and no yardstick to judge performance. That is standard cost versus estimated cost. Historical costs are those costs which are computed after the production, after the job or process is complete. Predetermined costs, on the other hand, denote cost computed in advance, before production, before job and process has commenced. Predetermined costs are of two types: estimated cost and standard cost. We are required to study estimated costing to see how the cost of contract, in which almost estimated cost we have studied in chapter cost accounting, as well as in case of contract costing, where before the end of contract we try to estimate the amount of profit which will be received by the contractor after the completion of contract. However, standard cost and estimated cost differ from each other in following respects: basis of specification versus estimates. Standard cost denote cost determined in advance on the basis of specification affecting the cost. Estimated cost denote cost determined in advance on the basis of estimated of all factors which will affect the cost. Ought to be and will be cost. Standard cost indicate what a cost ought to be, it should be, and while estimated cost indicate what the cost will be. Controllable versus uncontrollable cost. Standard costs are determined in advance, presuming that costs can and will be controlled by the management. Estimated costs are determined in advance, presuming that the cost will not be so controlled. Establishment of standard cost. Predetermination, preliminaries, length of period of use or types of standard to be used, review of existing procedures, classification of accounts, review of existing coding system. Standard overheads. Standard overhead means the standard rate for absorption of overhead. This rate may be per hour, per unit, depending upon the method of absorption. Standard overhead rate per hour. Budgeted overheads divided by budgeted hours. Standard overhead per unit will be budgeted overheads divided by budgeted quantity of output. Above formulas can be used to calculate separately the standard fixed overheads and standard variable overheads. The standard fixed overhead rate per hour, budgeted fixed overheads divided by budgeted hours, standard variable overheads rate, budgeted variable overheads divided by budgeted hours. Standard cost sheet. The first step in establishment of standard cost is to decide which type of standard, that is current standard or ideal standard, to use. The next step is to establish the standard for each element of cost in the manner explained above. After standard cost of material, labor, overhead is established in respect of product, the data can be presented in standard cost sheet as follows. Standard direct material, standard quantity multiplied by standard price. Standard direct wages, standard hours multiplied by standard wage rate, we get standard prime cost. Standard variable overheads, standard hours multiplied by standard variable overheads rate. Standard fixed overheads, standard hours multiplied by standard fixed overhead rate, we get standard overheads. Finally, we get standard cost, prime cost plus overheads. To this we can add profit to arrive at sale amount. Once the standard cost for each element is determined, the next step is to compare it with actual cost and find out the difference. Such difference between the actual cost and standard cost is known as cost variance. Variance analysis. Variance analysis: cost versus sales variance, favorable, unfavorable variance, controllable versus uncontrollable variance. Categories we have: quantity and price variance, total cost variance, quantity variance, rate variance. Causes of variances: material price variances, change in market price, loss of discount, incorrect shipping instruction, emergency purchases, acceptance of order requiring special purchases, high transportation cost, changes in taxes and duties, inefficient purchase system, failure to take advantage of seasonal purchases, use of substitute material of different prices, uneconomic size of purchase order. Material usage variance, poor quality of material, changes in mix, changes in production method, changes in design, careless handling, faulty machine processing, improperly set standards, poor inspiration, labor inefficiency, improper engineering specification, pilferage of material, substitution of non-standard material. Third, labor rate variance, use of defective grading of employees, payment of wages at higher rates to carry on emergency operations, revision of pay scales due to national awards, establishment of incorrect standard by personnel department, change in philosophy of management leading to change in method of remuneration, new workers not being allowed full wage rate, labor efficiency variance, poor working conditions, poor supervision of workers, poor scheduling of production process, poor maintenance and repairs of machines, use of substandard materials, use of employee with low competence, frequent power failures, go slow techniques of employees, incorrect recording of performance, increase recording of performance. Now material variances. Material cost variance is the difference between standard cost of material as specified for the output achieved and the actual cost of direct material used. How to compute this? Material cost variance is equal to standard cost for standard quantity minus actual cost for actual quantity. Formula: standard quantity multiplied by standard price minus actual quantity multiplied by actual price. Interpretation: material cost variance is said to be favorable when the actual cost is less than the standard cost, and adverse when the actual cost is more than standard cost. This variance is caused by the variations in quantity and the price. This variance is caused by the variations in quantity and price. Hence, the material cost variance is further divided into material usage variance and material price variance. Material usage variance. Material usage variance is that portion of material cost variance which is due to difference between the standard quantity and actual quantity. Computation: standard cost for the standard quantity minus standard cost for actual quantity. Interpretation: if the actual price is equal to standard price, material cost variance is equal to material usage variance. Material usage variance is said to be favorable when actual quantity used is less than standard quantity, and adverse when actual quantity is more than standard quantity. Favorable material usage variance gives rise to abnormal gains. Adverse material usage variance gives rise to abnormal loss, which we have studied in chapter of process costing. Material price variance. Material price variance is that portion of material cost variance which is due to difference between the standard prices specified for the actual output and the actual price paid. Being a rate variance, it is computed in following manner. Material price variance is equal to standard price minus actual price multiplied by actual quantity. Standard cost for actual quantity minus actual cost for actual quantity. Material price variance is said to be favorable when the actual price is less than standard price, and adverse when the actual price is more than standard price. Verification: material cost variance can be verified as material usage variance plus material price variance. परत घेऊ.
सर तुम्ही बोलताना तुमचा हँड फोड होता.
Material cost variance can be verified by adding the two sub variances, material usage variance plus material price variance. Calculation and reconciliation of material variances. Basic calculation we are required to do. We are required to check actual output. Then we are required to check actual output. Then we are required to calculate standard quantity for actual output. Standard quantity for actual output is equal to standard input divided by standard output multiplied by actual output. Calculation of variances. Material cost variance, standard quantity multiplied by standard price minus actual quantity multiplied by actual price. Material usage variance, standard quantity minus actual quantity multiplied by standard price. Material price variance, standard price minus actual price multiplied by actual quantity. In the same way, we can calculate labor cost variance, where our formula is labor cost variance is equal to standard labor cost minus actual labor cost. How to calculate standard labor cost? Standard hours multiplied by standard rate minus actual hours multiplied by actual rate. Similar to material cost variance, in case of labor cost variance, we can have two sub variances: labor efficiency variance and labor price variance. Labor efficiency variance means standard hours and actual hour difference we are going to take, and we are required to apply with actual rate. Similarly, we can calculate labor rate variance, where we are going to compare standard labor rate and actual labor rate for actual hours. These two sub variances, labor efficiency variance plus labor rate variance, will be equal to labor cost variance. In this particular chapter, we are going to focus only on two variances, material cost variance and labor cost variance, as overhead variance is not included in the syllabus of TYBCOM. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.